Federal Reserve Chair Jerome Powell issued a stark warning about the economic consequences of recent tariffs. His message was clear and unambiguous, highlighting the potential risks that these tariffs pose to the U.S. economy. Powell emphasized that while tariffs are often used as a tool to protect domestic industries, they can also have unintended negative effects. In a speech at the Economic Club of Chicago, Powell cautioned that tariffs could lead to higher prices for consumers and slower economic growth. He explained that the increased costs of imported goods would likely be passed on to consumers, resulting in higher prices at the checkout counter. This in turn could reduce consumer spending, which is a critical driver of economic growth. His words sent shockwaves through the financial markets, underscoring the gravity of the situation. Investors reacted swiftly, with stock prices experiencing significant volatility. The uncertainty created by Powell's warning added to the already fragile market sentiment, causing many to reassess their investment strategies. Powell's warning came amidst a backdrop of escalating trade tensions and growing uncertainty about the future of the global economy. The trade war between the U.S. and its trading partners has been intensifying, with both sides imposing tariffs on a wide range of goods. This has led to disruptions in global supply chains and increased costs for businesses. The significance of Powell's statement cannot be overstated. As the head of the Federal Reserve, his insights and assessments are closely watched by policymakers, economists, and investors around the world. His warning serves as a reminder of the interconnectedness of the global economy and the potential ripple effects of trade policies. As the head of the U.S. Central Bank, his words carry immense weight in the financial world and beyond. Powell's role is to guide the U.S. economy through monetary policy, and his statements can influence everything from interest rates to stock market performance. His recent comments have prompted a re-evaluation of economic forecasts and strategies. When Powell speaks, investors listen, and his recent pronouncements have injected a dose of reality into markets that had been seemingly impervious to bad news. The reaction from investors highlights the delicate balance that exists in the financial markets, where confidence can be easily shaken by new information. The coming months will reveal the full impact of these tariffs. But one thing is clear: the economic landscape is shifting, and the consequences will be felt by all. Consumers, businesses, and investors alike will need to navigate this new terrain, making adjustments to their spending, pricing, and investment decisions. The road ahead is uncertain, but Powell's warning provides a crucial perspective on the challenges that lie ahead. Tariffs, in essence, are taxes on imported goods. They are often used by governments to protect domestic industries from foreign competition by making imported goods more expensive. This can encourage consumers to buy domestically produced items instead. However, the impact of tariffs is far-reaching and can have unintended consequences. When the government imposes tariffs, the cost of those goods increases for businesses that import them. This means that companies that rely on imported materials or products must now pay more to bring those items into the country. This increase in cost can disrupt business operations and affect their bottom line. These businesses then pass on some or all of that cost to consumers in the form of higher prices. Retailers and service providers adjust their pricing strategies to account for the increased expenses, which means that everyday items become more expensive for the average consumer. This can lead to a decrease in consumer spending and affect the overall economy. This means that when you buy a product that has been subject to a tariff, you are paying more for that product than you would have otherwise. The additional cost is essentially a hidden tax on consumers, which can add up over time, especially for frequently purchased items. This can strain household budgets and reduce disposable income. The recent tariffs imposed by the Trump administration are particularly significant due to their size and scope. These tariffs have targeted a wide array of goods affecting various sectors of the economy. The intention behind these tariffs was to protect American jobs and industries, but the ripple effects have been felt across the board. These tariffs cover a wide range of goods, from steel and aluminum to electronics and consumer products. The manufacturing sector in particular has been heavily impacted, as many industries rely on imported raw materials to produce their goods. This has led to increased production costs and consequently, higher prices for finished products. The tariffs have already resulted in price increases for businesses and consumers alike. Companies are finding it challenging to absorb the additional costs, leading them to pass these costs on to consumers. This has created a cycle of rising prices that affects everyone, from small business owners to everyday shoppers. For example, the price of washing machines has increased by nearly 20% since tariffs on imported washing machines were imposed. This is just one example of how tariffs can directly impact the cost of household items. As tariffs continue to be a tool in trade policy, consumers should be aware of how these taxes on imports can affect their daily lives and financial well-being. The Federal Reserve is tasked with maintaining a healthy economy. This involves a delicate balancing act. The Fed has two main goals: keeping inflation low and stable and maximizing employment. Inflation is the rate at which prices for goods and services increase over time. When inflation is high, it erodes the purchasing power of money. The tariffs imposed by the Trump administration have made the Fed's job more difficult. The tariffs are inflationary because they increase the price of imported goods. This puts upward pressure on inflation. At the same time, the tariffs could slow economic growth. This is because they make it more expensive for businesses to invest and hire. The stock market, a barometer of investor sentiment, has reacted negatively to the uncertainty surrounding tariffs. Investors are on edge, fearing that the escalating trade war could lead to a slowdown in global economic growth. The ripple effects of these fears are being felt across various sectors, from technology to manufacturing. The Dow Jones Industrial Average, a widely followed index of stock market performance, has experienced significant volatility in recent months, with sharp declines following announcements of new tariffs or escalations in trade tensions. This volatility is not just a number on a screen, it represents the uncertainty and anxiety of millions of investors who are trying to navigate these turbulent times. The technology sector, heavily reliant on global supply chains and international trade, has been particularly hard hit. Companies that depend on the seamless flow of goods and services across borders are finding it increasingly difficult to operate under the shadow of potential tariffs and trade barriers. Companies like Apple, which manufactures many of its products in China, have seen their stock prices decline on fears that tariffs will cut into their profits. The potential for increased costs and disrupted supply chains is causing significant concern among investors and company executives alike. The uncertainty surrounding trade policy is making it difficult for businesses to plan for the future, leading to a decline in investment and hiring. Companies are hesitant to commit to new projects or expand their workforce when the economic landscape is so unpredictable. This cautious approach is having a ripple effect on the broader economy, potentially slowing down growth and innovation. Section 5. Rising prices, the inevitable impact on your wallet. The tariffs are already having a tangible impact on consumers. Prices for a wide range of goods, from washing machines and refrigerators to cars and clothing, have risen as businesses pass on the increased costs to consumers. These price hikes are squeezing household budgets and forcing consumers to make difficult choices. For families living paycheck to paycheck, even small increases in the cost of necessities can have a significant impact. The tariffs are disproportionately affecting low and middle-income households, who spend a larger portion of their income on goods and services. This is because these households have less disposable income to absorb price increases. Section 6. The job market conundrum, growth amid uncertainty. The tariffs are creating uncertainty in the job market. While the unemployment rate remains low, there are signs that job growth is slowing. Some businesses are putting hiring plans on hold as they wait to see how the trade war plays out. The tariffs are also disrupting supply chains and forcing businesses to relocate their operations. This is leading to job losses in some sectors and job creation in others. However, the overall impact on the job market remains uncertain. Section 7. Navigating the storm, practical advice for consumers. In these uncertain economic times, it is more important than ever for consumers to be financially savvy. This means creating a budget, tracking spending, and looking for ways to save money. Consumers should also be prepared for the possibility of continued price increases and economic volatility. One way to mitigate the impact of tariffs is to buy American-made products. However, this is not always possible or practical. Consumers should also be wary of businesses that use tariffs as an excuse to raise prices unnecessarily. By being informed and proactive, consumers can weather the economic storm. Section 8. A look back. Echoes of past economic challenges. The current situation is reminiscent of past economic challenges, such as the stagflation of the 1970s, characterized by high inflation, slow growth, and high unemployment. While the current economic environment is different in many ways, there are lessons to be learned from past mistakes. The stagflation of the 1970s was caused by a combination of factors, including rising oil prices, government spending, and loose monetary policy. The current situation is also complex and multifaceted, with tariffs being just one piece of the puzzle. Section 9. The road ahead. Uncertainty and the need for vigilance. The road ahead is uncertain, the outcome of the trade war is still unknown, and the global economy is slowing. The Federal Reserve is closely monitoring the situation and will adjust monetary policy as needed. In the meantime, consumers and businesses alike should brace for continued volatility. It is essential to stay informed about economic developments and to be prepared for any eventuality. The current economic climate underscores the importance of sound financial planning and the need for vigilance in the face of uncertainty.